My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Coming to you from San Francisco. Other people, my friends, I'm just trying to make you some money. My job is not just to entertain, but to educate, teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. How do we get to this bizarre dichotomy between tech stocks and pretty much everything else, where the two groups now almost always seem to move in opposite directions? Tech today, where the Dow Jones Industrial Average gained 228 points, S&P advanced 0.13%, but the Nasdaq, with all that tech in it, dropped a bomb. Yeah, it fell 0.52%. How could there be such a schism? It's because there's not enough money coming in from the sidelines. So these big institutions have to swap out of one group if they want to buy stock in another. Yet this action has nothing to do with the fundamentals. It's not about the news. It's about pure market mechanics. When stocks are already red hot, it's hard to attract new capital from the sidelines, especially when you can get a cozy 4% return for doing nothing. So either tech wins or everything else wins, but there's not enough cash for both of them to win at the same time. So what happens? We get winners and losers, not big winners and smaller winners, as you would normally expect on an up day like today. This is all against the backdrop of the big question. Will the Fed cut rates by 25 basis points or 50 when it meets on Wednesday? Now, you know me. I try to refrain from this parlor game of guessing the Fed's next move based on the strength of the economy. Last week, when the Wall Street Journal indicated the Fed may actually be leaning toward 50 basis points, we got this great migration, though, into the cyclicals, especially anything related to housing. Of course, last week, there was just enough good news to propel the entire market, which is why it was the best week of the year. Hey, don't forget, we had major gains in tech because Larry Ellison, the founder of Oracle, reported earnings last Monday and said that his company had 162 data centers, still need another 1,000, maybe 2,000. Then on Wednesday, NVIDIA's Jensen Huang spoke as part of a Goldman Sachs fireside chat, talking about how hard it is to allocate his best chips because everybody wants some. Sure enough, the next day, at an Oracle analyst meeting, Larry Ellison again told the story of a recent dinner he had with Jensen and Elon Musk, which he described as him and Musk begging Jensen for GPUs. Of course, that's NVIDIA's product. Now, you might think these high-quality problems with overwhelming demand could continue to resonate in today's session, but then you'd be really wrong. The big winners today were the cyclical stocks, including housing. We also had some solid performance in the banks and a good return from the consumer products companies, something that's not supposed to happen when the Fed's cutting rates. But all of tech, save Oracle, again from last week, IBM and Intel, which has some good news about a partnership with Amazon after the close, stagnated or fell flat on their faces. Which leads me to this newfound great divide between tech and non-tech, because that's how this market seems to be trading. It's a big reason why I'm out here in Silicon Valley this week. Today, we saw a market that doesn't believe in AI, or tech in general, for that matter. It's a market that believes a 50 basis point rate cut will shift money from semiconductors to housing and anything housing related, and people want to get ahead of that. Today, the winners broadened out. The healthcare stocks got jiggy, retailers were, consumer packaged goods companies outperformed. Even the much maligned oils are rallying. It's crazy. Healthcare and consumer products should be selling off when the cyclicals were. But that's not what's happening because it's ABT. No, I'm not talking about the symbol for Abbott Labs, for heaven's sake. ABT means anything but tech. And that's what today's market was about. Oh, the implications are pretty stark, people. Market commentators call this a rotation, but that understates what's really happening here because the move is so vicious and devoid of realism. The market's action is dictating what we do. For example, we know that the principal beneficiaries of rate cuts, namely the housing stocks, roared today. This is the second day these stocks jumped because mortgage rates continue to plummet. That's how Lennar, Toll, and Horton can all hit highs. Makes sense. Day one last Friday, we had enough money to go around. That's why today the Dow, bereft of a lot of tech, could hit all-time high levels. But today, day two, was also zero-sum. The money poured out of, say, Apple, on word from a select few firms that the weekend's pre-orders for the new iPhone 16 were anemic. More on that later. All you need to know is it caused an eruption of selling in anything connected to Apple, including Broadcom and ARM Holdings. Hey, we got them on tonight. Let's see what they have to say. The weakness in the Magnificent Seven was palpable, led by NVIDIA, which came back down after last week's miraculous run. The thing is, it's not that Wall Street's turning against tech. It's just that there's not enough money coming in. So if fund managers want to buy something new, they're selling their biggest winners to raise money. and the biggest winners are in tech. Money's coming out of these stocks like a dam breaking, with newfound river flowing into beaten down stocks like Whirlpool, off 17% for the year, Ulta off 20%. Both stocks were up huge today. Again, this is just the mechanics of money management speaking. There's nothing wrong with tech. As you will hear later from ARM, I think you can tell. Very good story. This is incredible. Hey, by the way, I think you're going to hear good things from Broadcom. Business is simply booming, massive upside. Micron, which was down awfully today, is having a tremendous moment. Semiconductors and PC sales are bottoming, while high bandwidth AI chips sales are soaring. Now, we don't know if Apple's new iPhone 16 is a hit. You can't even buy one until Friday, for heaven's sake. But early reports of weak pre-orders, stories I doubt, are causing the stock to get slammed because money managers need to raise cash to position themselves for the Fed meeting. Apple shares are being sold to fund buys in the Whirlpools and the Ultas. And yes, NVIDIA, that stock's still struggling since that last earnings report. NVIDIA's doing better than ever, but it doesn't matter. NVIDIA's like the rest of tech. Almost all these stocks are just share donors to the rest of the market. So look, that's descriptive. What happens next? Look, we are at a difficult juncture. Traders, not investors, but big institutional traders, are the ones in the driver's seat. They're making the prices that you see. As long as we expected only a 25 basis point cut, there was a decent amount of money being allocated to both groups, tech and non-tech. But the 50 basis point cut shatter, that tipped the scales out of tech and into all sorts of stocks that will get clobbered if the Fed doesn't deliver on a double rate cut. If that's the case, the Fed only cuts by a quarter of a point, then we're going to have a wholesale shift back to those companies that don't need a double rate cut to thrive. Most of the high-profile techs don't need the double rate cut. They don't need a single rate cut. So the money should flow back into tech after this initial sell-off that we're probably going to get when the Fed talks about 25. So what are you supposed to do? I think it's simple. I know it's boring. I want you to sit on your hands. There's so much hot money coming out of tech and into non-tech. I don't want you to get in the way of that, because without a half-point cut, I'd say that the non-tech part of the stock market will have suddenly become overvalued. Why am I so circumspect about this moment? Simple. Because nothing's really happening, save the launch of the iPhone 16, which doesn't technically happen until the 20th. Yet it's already considered a bust. Yeah, thanks a lot. Bottom line. If we only get a quarter-point cut, all of that money that came into non-tech, hoping for immediate better times, it flows right back to where it came from. The tech stocks that got sold today. It's silly. It's infantile. It's confusing. It's a total impenetrable mess, unless you've seen it before. Take it from a grizzled veteran. Don't try to chase this move. It's not worth it. You will just be frittering away your hard-earned cash. Let's take calls. Let's start with Nick in California. Nick.
Hey, Jim, long-time listener, first-time caller. I just had a question about this whole crypto market. Do you think it's a good time to buy the stock Coinbase?
If you think the crypto market is good, don't buy Coinbase. Go buy why don't you buy an ETF for Bitcoin, or go buy Ethereum? Those are the direct plays. You don't want an indirect play. Go for the best. Go for the simple. Jeff in Kentucky. Jeff.
Hey, Jim. I'm a longtime member of the investment club and appreciate everything you and Jeff do for us.
Thank you very much for saying that. We work pretty hard. Jeff's not out here with me. I'll tell him you said that. He'll probably watch the show. What's going on?
All right, we'll go. Hey, Jim, one of the investments I have that is outside of the club holdings is Lam Research, LRCX symbol. It's had a rough couple of months, losing about 400 points, and it didn't really participate in this tech and chip rebound we've seen over the last couple of weeks. And after today, it's about 120 points below its 200-day moving average.
Jeff, I got to tell you, I think Lam is dramatically oversold. I think it could be a coiled spring. Maybe it has 50 down, but I think it'd have 200 up. I agree with you, and I know the company for a very long time, certainly more than the traders who are dumping it right now. So anyway, don't try to chase this move out of tech, please. I've seen this kind of thing before. It's just not worth your effort. It will just involve you churning your dollars and losing money. On Mad tonight, I'm kicking off my week on the West Coast with Broadcom's top brass. They hardly ever talk. After a big bounce back last week, I'm getting a better read on where the stock stands in the AI space. Then Elf Beauty's report sent the stock slower, despite a top and bottom line beat. So you're getting a real opportunity to buy this great beauty company again at a bargain. I'm taking a closer look at the CEO. And later, I've got a exclusive with ARM Holdings on the heels of its 1-year IPO anniversary. So stay with Cramer.
Don't Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.